In a political climate already fraught with tension, a new wave of speculation has emerged around the UK's financial landscape. Labour's Chancellor, Rachel Reeves, has ignited debate with proposed changes affecting pensions, ISOs, property, and inheritance tax. Headlines across the country describe these moves as a tax grab, stoking anxiety among savers and property owners. While much of the discussion is fueled by speculation, there are confirmed policy intentions that demand careful attention. Understanding what is factual versus rumor is crucial for those seeking to protect their financial futures amidst these proposed reforms. The Chancellor faces a complex challenge, balancing fiscal responsibility with political promises. After years of economic strain, the UK government must address a significant budget shortfall, with estimates exceeding £30 billion. Labour officials have proposed measures to broaden the tax base, aiming to capture revenue in subtle ways. Among the most discussed proposals is a limit on salary sacrifice pension contributions, designed to prevent high earners from excessively reducing their taxable income. These measures are part of a broader strategy to strengthen public finances while avoiding headline-grabbing tax increases that could provoke widespread backlash. Salary sacrifice pensions have long provided both tax and national insurance advantages. By contributing to pensions before taxes, employees and employers can reduce overall taxable income. The proposed cap of £2,000 annually would reduce these benefits for higher contributions, subjecting them to standard NI rates. For some professionals, this could mean an increase of thousands of pounds in annual deductions, affecting long-term retirement planning. While Labour frames this as ensuring fairness, critics argue that it undermines prudent financial planning and disproportionately affects those who have actively sought to save responsibly for their retirement. The government projects that the pension contribution cap could generate approximately £2 billion in annual revenue. While this is modest relative to the overall budget, it carries symbolic weight, signaling Labour's willingness to target previously untouchable reliefs. The measure is intended to close perceived loopholes, but it also raises concerns about consistency in policy. Financial experts emphasize that even small adjustments can ripple through investment behavior, affecting pensions, spending, and long-term wealth accumulation. For ordinary workers, the change could feel like a direct attack on their ability to plan securely for the future. Beyond pensions, the freeze of income tax thresholds is another subtle yet impactful measure. With salaries rising due to inflation, workers may inadvertently move into higher tax brackets despite no real increase in purchasing power. This phenomenon, often referred to as fiscal drag, quietly raises government revenue while avoiding explicit tax hikes. It affects millions, from professionals to retirees, subtly increasing tax liabilities over time. For those paying attention to their finances, this silent chain highlights the importance of monitoring tax bands and planning ahead to mitigate its impact on disposable income and long-term savings. Individual savings accounts, or ISAs, remain a focal point of speculation. These tax-free savings vehicles have historically encouraged prudent financial behavior, offering a safe haven for investments and interest earnings. Rumors suggest potential reductions in annual allowances or alterations to the tax-free status of certain ISOs, particularly cash-based accounts. While no official measures have been confirmed, the uncertainty has caused concern among savers. Financial planners recommend maintaining flexibility and being prepared for adjustments, emphasizing that patience and careful monitoring of official announcements remain essential in navigating potential changes to personal saving strategies. Property owners are also closely watching potential changes in taxation. Inheritance tax, particularly the residence nil rate band, is under review. Labour may extend the period required for gift to become exempt from inheritance tax, currently 7 years. Adjustments to exemptions for family homes could impact ordinary homeowners, not just the wealthy. For middle-class families with substantial property holdings, even modest policy tweaks could result in significant tax liabilities. The uncertainty surrounding property taxation emphasizes the importance of proactive estate planning, ensuring that families can safeguard assets and minimize potential financial disruptions from future government policies. The Chancellor's office has emphasized that these changes are part of a broader effort to modernize the tax system. Labour argues that the reforms aim to ensure fairness, preventing high earners and asset holders from benefiting disproportionately from tax reliefs. Critics counter that the measures penalize those who have acted responsibly, discouraging saving and investment. Public opinion is divided. with some perceiving the policies as necessary fiscal adjustments, while others fear an erosion of trust in the government's ability to provide stable and predictable financial guidance over the long term. Media coverage has amplified concerns, framing Labor's proposals as a direct threat to middle-class savers and retirees. Headlines such as retirement savings under threat and pension raid looms dominate discussions, often without distinguishing confirmed policy from speculation. This heightened narrative has contributed to anxiety, leading many to consider preemptive financial decisions. Analysts caution that acting on rumors alone could result in suboptimal outcomes, emphasizing the importance of evidence-based planning. Following official guidance and monitoring reputable sources is crucial for those seeking to navigate the evolving financial landscape effectively. The potential changes have triggered early reactions from financial advisors across the country. Many clients are reviewing ISA contributions, pension arrangements, and property holdings, seeking to mitigate potential tax implications. Some consider maximizing current allowances, transferring assets strategically, or adjusting investment portfolios. Advisors highlight the importance of maintaining a balanced approach, avoiding rash decisions that could inadvertently reduce wealth. Strategic planning, rather than reactionary moves, is emphasized as a key to navigating this uncertain environment. Prudence and careful evaluation remain paramount as individuals assess how to protect and grow their financial resources in the face of evolving policies. Labor's political messaging stresses the notion of fairness and shared responsibility. The Chancellor has stated that the core reliefs, such as the 25% tax-free pension lump sum, will remain intact. However, the combination of threshold freezes, caps on salary sacrifice contributions, and potential tweaks to ISOs and inheritance tax introduces complexity. Understanding these nuances is essential for taxpayers, as minor adjustments can have disproportionate effects on personal finances. Effective communication from the government and informed financial planning by citizens will determine how successfully these measures are implemented and how public confidence in the fiscal system is maintained. The backdrop to these proposals is a challenging economic environment. Inflationary pressures, rising living costs, and the aftermath of pandemic-era borrowing have left the UK's public finances in a fragile state. Labour's measures are intended to shore up revenue while balancing political promises of protecting working families. The debate centers on whether these interventions are fair and necessary or whether they inadvertently punish savers and homeowners. For citizens, understanding the context behind policy decisions is as important as analyzing a potential impact, providing perspective on why certain fiscal adjustments are being considered at this critical juncture. Analysts note that policy uncertainty can have tangible effects on behavior. Individuals may alter spending, investment, and saving patterns in response to perceived threats to their financial security. The anticipation of changes to pensions, ISOs, and property taxes can lead to short-term market movements, affecting asset prices and investment confidence. Economists warn that a measured approach is essential, balancing fiscal needs with the importance of maintaining incentives for saving and investment. Effective communication from the government and informed planning by individuals can help mitigate unintended consequences, ensuring stability in both personal finances and broader economic trends. Retirees, in particular, face heightened exposure to these proposals. Many rely on pension income and tax-free savings for daily expenses. Even subtle changes to thresholds or reliefs can materially impact disposable income. Organizations representing seniors and retirees have voiced concerns, emphasizing that predictability is critical for long-term financial security. Policymakers must weigh the benefits of revenue generation against the potential for increased financial stress among vulnerable populations. For individuals approaching or in retirement, careful review of pension strategies and potential adjustments to savings allocations is recommended to maintain stability amid potential policy shifts. ISOs, long considered a cornerstone of personal financial planning, may experience uncertainty. While official measures have not been finalized, speculation alone is affecting decision-making. Investors are evaluating how potential reductions to contribution limits or changes in tax treatment could impact their portfolios. Advisors recommend maintaining flexibility, diversifying holdings, and monitoring official announcements closely. Understanding how changes might interact with broader financial plans, including pensions, property, and inheritance considerations, is critical for minimizing risk. Thoughtful planning now can prevent last-minute reactions that may result in unnecessary tax liabilities or missed opportunity for growth. Inheritance tax considerations remain central to discussions around property and wealth transfer. Modifications to the residence nil rate band or extension of the gifting horizon could significantly influence estate planning strategies. Families may need to reassess gift timing, trust structures, and property transfer arrangements to mitigate potential liabilities. Professional advice is crucial, as subtle regulatory changes can have outsized financial consequences. Awareness and strategic planning allow individuals to adapt proactively, ensuring that assets are preserved and transferred according to their intentions while minimizing the impact of evolving tax policy. Property owners with second homes or rental investments are also attentive to potential reforms. Discussions around capital gains tax, stamp duty adjustments, and exemptions for landlords highlight the complexity of property taxation. Labor frames these measures as efforts to address inequality and encourage fairness in the housing market. Critics argue that excessive taxation could reduce investment incentives, impacting rental availability and affordability. Navigating these proposals requires a comprehensive understanding of both current legislation and potential changes, enabling property owners to anticipate financial implications and make informed decisions about portfolio management and long-term investment strategy. The interplay between pensions, ISOs, and inheritance tax creates a web of considerations for taxpayers. Changes in one area can cascade, affecting decisions in another. For example, reducing ISA allowances may influence retirement planning, while inheritance tax modifications could affect property decisions. Understanding these interconnections is essential for creating a cohesive financial strategy. Advisors recommend comprehensive planning that considers all aspects of personal finance, from savings and investments to estate and tax implications, ensuring that individuals can respond effectively to policy changes while preserving long-term financial stability and meeting their goals. Labor emphasizes that their proposals are designed to create a fairer system. By targeting reliefs perceived as disproportionately benefiting higher earners, the government aims to redistribute revenue in a manner that supports public services. While the narrative is politically charged, understanding the rationale behind policy decisions provides context for evaluating potential impacts. Citizens and businesses alike benefit from analyzing proposals critically, separating speculation from confirmed measures, and preparing strategic responses. This approach allows for informed decision-making that aligns with individual financial priorities while adapting to an evolving tax landscape shaped by government policy and economic conditions. Public reaction has been varied, reflecting the diversity of financial situations across the UK. Some applaud the intention to close loopholes and ensure equity, while others worry about unintended consequences for savers and retirees. Media narratives play a powerful role in shaping perception, often amplifying concerns and influencing behavior. Understanding the difference between rumor and policy is critical, as premature actions can create unnecessary financial disruption. Individuals are encouraged to monitor official announcements, consult with qualified financial professionals, and make measured adjustments to their strategies rather than reacting impulsively to speculative reports. Financial advisors stress that preparation is key. Reviewing pension contributions, ISA allocations, and property holdings in light of potential changes allows individuals to take proactive steps. Scenarios can be modeled to evaluate the impact of proposed reforms, providing clarity and confidence in decision-making. Flexibility is crucial, as the final policy details may differ from speculation. Maintaining a balanced approach ensures that wealth is preserved, growth opportunities are optimized, and risk is managed effectively. Thoughtful planning enables individuals to navigate uncertainty with confidence, safeguarding their financial future against evolving government policies and economic pressures. Budgetary uncertainty also affects investment markets. Anticipation of tax changes can influence asset prices, market confidence, and investment behavior. Investors may shift portfolios toward lower-risk assets or adjust allocations to mitigate exposure. Analysts recommend a disciplined approach, avoiding reactionary decisions based on rumor. Instead, a strategic assessment of potential outcomes, combined with ongoing monitoring of government announcements, helps maintain stability and maximize long-term returns. Understanding the connection between policy decisions and market dynamics is essential for investors seeking to protect capital and pursue growth while navigating an unpredictable fiscal environment. The broader economic context underscores the challenges faced by policymakers. Inflationary pressures, high public debt, and lingering effects of pandemic-era spending constrain options. Labor's measures aim to address these fiscal realities while maintaining commitment to fairness and social equity. Balancing revenue generation with economic growth is complex, requiring careful calibration of tax policy and relief structures. Citizens and businesses alike must stay informed about potential changes, assess their financial positions, and implement strategies that minimize risk while positioning themselves for future stability and prosperity. Long-term financial planning requires careful attention to evolving policy. Tax reliefs, thresholds, and exemptions are not static. They reflect broader economic and political priorities. Individuals who regularly review and adjust their strategies are better positioned to respond effectively. Professional guidance can provide insight into nuanced policy changes, helping individuals optimize outcomes while remaining compliant with regulatory requirements. Remaining informed, adaptable, and proactive ensures that financial plans remain robust even as government proposals and fiscal conditions evolve over time. The narrative around Labor's tax grab emphasizes a tension between government revenue needs and individual financial security. While the terminology is politically charged, underlying policy discussions reflect genuine concerns about sustainability and fairness. Evaluating the measures critically allows individuals to discern legitimate planning consideration from sensationalized media reports. Strategic financial management, grounded in accurate information and professional advice, empowers citizens to navigate uncertainty and protect their wealth in a landscape where policy can shift rapidly in response to economic pressures and political priorities. Strategic estate planning has become increasingly important as potential changes to inheritance tax loom. Families are exploring trust, gifting strategies, and early transfers to minimize liabilities. While these moves require careful consideration and professional guidance, they offer opportunities to preserve wealth and ensure assets are passed on according to intentions. By staying ahead of possible policy changes, individuals can mitigate the financial impact of any adjustments Labor may implement, particularly regarding residence nil-rate bans, gift exemptions, and property transfers, which could otherwise create unexpected burdens for heirs and complicate long-term family financial planning. Business owners and self-employed individuals are also scrutinizing Labor's proposed reforms. Pensions, ISOs, and property holdings often intertwine with business assets, making careful planning essential. Changes to salary sacrifice caps could influence decisions around profit distribution and retirement contributions, while adjustments to taxation thresholds may impact overall net income. Professional advisors encourage evaluating the interplay between personal and business finances, ensuring compliance while optimizing tax efficiency. This holistic approach helps safeguard financial stability, allowing business owners to maintain growth and operational flexibility while navigating potential regulatory changes that may affect both personal and corporate financial outcomes. Market analysts warn that uncertainty around Labor's proposals could influence investor confidence. Even without concrete policy changes, speculation can shift asset valuations, affect capital flows, and alter market dynamics. Investors may adjust portfolios toward safer assets, reduce exposure to property, or reconsider retirement investments. The cumulative effect of these decisions can ripple through the economy, emphasizing the importance of informed strategy. By maintaining a disciplined, evidence-based approach, individuals and institutions can mitigate risks associated with policy uncertainty, preserving wealth and ensuring financial plans remain resilient amidst evolving fiscal and regulatory landscapes. Public sentiment toward the proposed reforms is mixed, reflecting the diversity of financial circumstances across the UK. Some view measures targeting pension reliefs and ISA allowances as necessary steps toward fairness and fiscal responsibility, while others perceive them as penalizing prudent saving and investment. Understanding the rationale behind Labor's approach, as well as the potential impacts on different socioeconomic groups, helps citizens make informed decisions. By evaluating both the benefits and risks, individuals can strategically plan for future changes, reducing uncertainty and positioning themselves to respond effectively to shifts in taxation and government policy. Educational efforts around financial literacy have become increasingly important. With complex reforms under discussion, understanding pensions, ISOs, inheritance tax, and property implications is critical. Governments, financial institutions, and independent advisors provide guidance, helping individuals navigate potential policy changes. Informed citizens are better equipped to make decisions that protect their wealth, optimize savings, and maintain financial security. By proactively seeking knowledge and professional advice, taxpayers can anticipate adjustments, avoid reactive mistakes, and strategically position themselves to benefit from legitimate opportunities while mitigating exposure to unwanted taxation. Long-term financial resilience is achievable through diversification and strategic planning. Individuals who balance savings, investments, property holdings, and retirement accounts are better prepared for policy changes. By monitoring government proposals and staying informed about thresholds, exemptions, and allowances, citizens can adjust their strategies proactively. Professional advisors play a crucial role in modeling scenarios and recommending actions that align with personal goals. This disciplined, forward-looking approach ensures that individuals maintain financial stability, reduce uncertainty, and safeguard assets against potential policy adjustments affecting ISAs, pensions, property, and inheritance tax. Engaging with reputable sources is essential to differentiate between rumor and confirmed policy. Social media and sensationalist media coverage often amplify concerns, creating unnecessary panic. By relying on verified announcements from government agencies, financial institutions, and respected media outlets, individuals can make decisions grounded in fact. This clarity allows for measured responses to potential reforms, enabling strategic planning without reacting impulsively to speculation. Remaining informed, vigilant, and proactive ensures that financial decisions are based on credible information rather than fear-driven narratives. For many, the proposed reforms highlight the importance of revisiting long-term financial plans. Individuals approaching retirement may adjust pension contributions, reallocate investments, or explore tax-efficient savings options. Property owners might evaluate transfer strategies, optimize estate planning, or assess capital gains exposure. By integrating anticipated policy changes into overall financial planning, citizens can protect wealth, maintain flexibility, and respond to government adjustments effectively. Early assessment and strategic decision-making empower individuals to navigate uncertainty while optimizing financial outcomes and maintaining confidence in their personal economic stability. Labor's approach reflects broader trends in fiscal policy, governments seeking to balance revenue generation with equitable distribution of tax reliefs. By targeting areas perceived as disproportionately benefiting certain groups, Labor aims to ensure fairness while addressing budgetary pressures. Understanding this context is critical for citizens interpreting proposed changes. Awareness of economic rationale, alongside careful financial planning, allows individuals to respond strategically to reforms while preserving savings, investments, and property. By approaching potential changes with knowledge and foresight, taxpayers can reduce risk and maintain confidence in their financial trajectory, even amid evolving government priorities. As the UK approaches the autumn budget, the significance of these proposals becomes clear. The combination of pension caps, ISA uncertainties, inheritance tax reviews, and property taxation considerations represents a potential shift in the financial landscape. For savers, retirees, and property owners, vigilance and strategic planning are essential. By proactively engaging with advisors, monitoring credible updates, and adjusting financial plans accordingly, individuals can navigate uncertainty effectively. Preparing ahead, rather than reacting to headlines, ensures resilience and stability, allowing citizens to adapt confidently to potential policy changes while safeguarding their financial future in a changing economic environment.